Ladies and gentlemen, we have the second panel of the day, which is going to be moderated by Ankit Bagadia, Associate Director, Bank Bazaar. So can we give a huge round of applause for Mr. Ankit, ladies and gentlemen. Then we have Sandeep Jain, Fund Manager, Baroda BNP Paribas Mutual Fund. Let's give it up for Mr. Sandeep, guys. I need more claps. I need a little bit of more energy to welcome the speakers. Then we have Soumee Bhatt, founder and managing partner, Bombay Juris Law Offices. So can we please give it up for Soumee Bhatt, guys? Let's give it up for the lady here. And the next we have Balaji Jagannathan, co-founder and chief strategist, 𝐃𝐬𝐬𝐬𝐢. Let's welcome Mr. Balaji. So this is panel number 2 of the day, and we are going to be discussing on the topic, the evolution of credit and lending models. Thank you so much, guys, for making it, and over to you. Thank you.
Sure. So that's the first statement that I make every day whenever I am on a call. So and thanks to the lovely and beautiful audience here. And what a rock solid, power packed first panel discussion we had. Thank you so much, guys, for setting up the context early in the day. So good morning, everyone. In fact, just good afternoon, everyone. I'm Ankit Bagadia. I manage strategic partnerships at Bank Bazaar. It's a privilege to be a part of this event, which is the 3rd edition of NBFC and Fintech Leadership Awards by Krypton India. Thank you for inviting us, team. So let me start with one of the lines that I recently caught my attention. So currently in India, 3 Indias coexist based on the purchasing power parity per capita. One of them, so out of the 140 crore people we have, 5 crore are Europeans, 45 crore are living as Indonesians, and the rest 90 crore are living as sub-Saharan Africans. If it has to be India's century, then we need to do something and uplift those 90 crore Indians living in quite desperation. And that brings me to my topic for today, which is evolution of credit and lending models in India. So I'll just dive deep into the topic, and we'll just have a workflow where we'll discuss certain topics. We'll invite the audience also to contribute and raise questions to the esteemed panelists. So just giving a context to the topic, over the last decade, we've seen a paradigm shift in the way the credit is being underwritten, distributed, and experienced in India. And right from those days where cash credit and formalized credit from the banks to the days where we are now looking at digitized lending in terms of tools like BNPL, sustainable finance, short-term credit tools, credit cards, etc. All these tools are available at the click of a button. I don't remember last I visited a bank for availing credit facilities. So, this is what the credit ecosystem has been, this is how the credit ecosystem has been reshaped in India. And let's understand the impact and possibilities ahead. So, Mr. Balaji, I'd just like to come to you directly. How are digital lending platforms reshaping credit delivery for traditional NBFCs? Are they seen more as collaborators or competitors?
First of all, thank you, everyone. So a quick background about myself. So I'm Balaji Jagannathan, and I'm co-founder and strategist at 𝐃𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬𝐬 we are into repayments, like, we process the repayments of things like EMIs and stuff like that. So that's my background. Having said that, I work closely with banks to start with, from the tech point of view. At present, we are focusing more on the payment space. So my responses would be on those lines, right? So I would like to take a goal like 10 or 15 years back, where we have a similar situation between banks and tech providers, right? There was a time, probably 10 years ago, there were a lot of questions about are tech providers or technology-based or fintechs taking over, the business from banking. We have a similar question being asked now between NBFCs and, fintech providers. So we can always learn from the past, I believe. in the last 10 years, we found that the banks have learned from what the fintech businesses have been doing, and they've caught up. And not only caught up, the banks have in fact taken over. That's how I've seen things evolve in the last 10 years. So going by the same pattern, I'm very confident to say that while today digital lenders are seen as serious competition, very quickly the traditional lenders would catch up, learn from what's happening at the digital lender level, and then I think both will collaborate. It would probably, I would say, like 4 to 5 years, and we would find a lot of collaboration. It starts as a competition, but a lot of collaboration. That's how I see things progress.
Yeah, I believe even in the first panel, hey, am I audible? Yeah, first panel itself, we saw that the collaboration between the tech and NBFCs is something which is helping turnaround time in terms of customer acquisition experience. And I believe there was a time when they were seen as a competitor, but now it's like more of a collaborative approach, which is bringing the best of both the industries together. So yeah, your thoughts, Mr. Sandeep?
So thanks for having me here. Just to give you my background, so from last 18 years, I am researching on this banking and financial services, right? So I have seen the evolution from the PSU bank, private bank, SFBs, fintech, lending, NBFC, and everybody. So in 2007 and 8, when NBFC were very aggressive, the sheer existence of NBFC has made is that to reach the customer, right? Where banks were not able to reach. The funding of the NBFC has been done by the bank, right? So the point is that now the fintechs, who is again, the funding of the fintechs has been done by the banks or NBFCs. In our industry, the penetration is so low that there is a market for everybody. The banks have their own salaried class market. The NBFCs has owned their niche market. The fintech has owned their quick turnaround time kind of market where people need money for some BNPL technology, some BNPL spending or some medical expenses. So this kind of digital funding market would be there. So it would be a more of a collaborative kind of approach rather than the competitive approach. And regulators have already kind of look at that, and they have come up with the co-lending model, or the DLG, that is a default loss guarantee model. So it's something that we have seen in the past also, that some new thing is coming and we are saying that it would be a competitor kind of, but it is always kind of collaborative. It is not that one thing will be there and another will be gone off the racks.
Agree. And in fact, glad that you brought up regulatory angle. We have Soumee with us. Soumee, I'll just pose this to you that, with nearly $2.5 billion being invested in digital lending platforms alone in the last 1 year. Where do you see this going ahead? Where do you see this scaling ahead in the next 2-3 years in terms of scale as well as in terms of regulatory compliance? I'm glad that we worked together on digital lending guidelines earlier, but yeah, DLG as well as DPDP that's coming up. Your thoughts?
Yeah. Yes, Ankit, as you rightly pointed out, I think the regulator has realized very rightly that with the boom of the fintech sector and the growing collaboration with the traditional players, so there was a need to regulate the sector. And RBI late in, I think, 2022, formed a working group, and that consisted not only the regulators, but industry experts, lawyers, a lot of people from other fields. And the working committee came up with the recommendations, which kind of got translated into the digital lending guidelines that we have now in place. The digital lending guidelines kind of say that the fintech players, they have been taken as a part of the ecosystem. They have been recognized as the outsourced service provider of the banks and the regulated entities, the NBFCs and all. So the way to survive and scale your business, for the fintech players, I think would be in compliance to the digital lending guidelines. Not just the DLG, but there are, of course, there's the outsourcing framework. There is a fair practices code and things like this. And I'm sure the regulator is observant of the system. So yes, I think the way to scale up would be to be in compliance with the regulations, and one needs to understand, just to understand the context of why RBI is coming up with the regulation. So I think for the regulator, it is always the consumer, who's kept at the heart of every regulation, and also to protect the financial ecosystem and make it robust. So these are the two things which is, I think, the regulator's mantra as well. And I think any institution can survive and scale up by following these guidelines.
Very true. Like consumer is at the heart of the regulation. Yes, Balaji.
I would like to make one important point here, once again taking from our experience from the banking, how the banking progress with digitization. Often we say, when we say digital lenders, for example, we talk about the new age lenders who are completely tech savvy and tech oriented. It's simply because they've started, at the time that they have started, they could digitize the whole thing and come across as digital lenders. But what happens over a period of time is even the traditional lenders who have been doing it the traditional way digitize, right? Yeah. At the end of the day, digitization is new way of looking at how to lend or how to do the same business, how to use what's available now and reshape how we operate. That's the transformation that all lenders, not just the new age lenders, but even the ones that are doing the business for such a long time, would transform into. One strength that the traditional lenders have is the processes that have been established over a period of time, which has kept them going quite well, right? Keeping the delinquencies low, identifying the right customers upfront, reducing the cost of failed payments, etc., which has been evolved over a period of time, which is available in the form of knowledge within the system, within their environment. So that advantage can be transformed into the digital environment, and they can actually step up and give a good competition if they see digital lenders as the competition. This is what banks have done in the last, if you see like 15 years, this is how banks have operated and transformed themselves. Now we find all the banks, even big and small, are very well digitized, right? When I go and see different banks in India and outside, I can clearly see that the Indian banks have really gone ahead, especially with respect to technology upgradation. And a lot of that has happened in the back office in the first place. And recently we are seeing even the front end, the customer facing has also gotten digitized quite well. Today we are not really talking about digital banking versus normal banking. Everyone is digitized now. This is how even the lending business would transform over the next 5 to 10 years. So in other words, digital lending will become the way and everyone will get there.
I'm sure. We are already there, and I'm sure it's going to rapidly go ahead and scale. Yeah. Right, and as they rightly said, in the first panel, that pay your lawyers well. We have a question in the audience. Can somebody please help with a mic?
Hello. Hello. Yeah. My name is 𝐾𝐚𝐧𝐞𝐥. I come from Poonala FinCorp. I represent the compliance department there. I've got around 25 years of experience in the banking industry. So while this is not a question, I would like to supplement the things what has been said. Anything to flourish or anything to go a long way, there has to be discipline around that. There has to be a framework around that. I think RBI is coming on very hard into that framework level of coming to digital lending era. So you have a lot of regulations which have been brought by RBI on the digital lending space today. The idea is to get all the data synchronized in one way. Tomorrow at the end of the day, what you are doing, we'll be playing with the data. So today, the one way to get into data is that about how to understand the customer behavior through the data only. So the digital way would actually help us to know how better we understand the customer and how quickly and how good product we can offer to the customer. Obviously, we have other regulations also from RBI, like fair practice code, and all they are also maintained from the customer point of view. But today, if you don't have a framework in place, then tomorrow we don't know where we land up. So this is very important that RBI is taking this lead so that we come in a very good way.
Agree.
That's what.
Thank you. Thank you for your inputs. I mean, that's the consensus, that we scale rapidly but responsibly. So just quickly moving to one of the topics that is covered in digital lending, and which is called as BNPL, which is buy now, pay later. Now, one of the oldest and raw experiences that I had of BNPL is when my grandmother used to call our grocery shop and buy some grocery items, and we used to pay later, month end, maybe after visiting them. That's the oldest idea that I have of. And now BNPL is much more institutionalized, formalized into the system, digitized into the system, and has seen explosive growth post-COVID in the last 5 years, but now faces tighter regulation. So my question to you, Sandeep, here is, what sustainable models do you see emerging in India for BNPL players?
Thanks, Ankit. So, see, BNPL, as you said, has seen a tremendous growth, and then we have seen the accidents also. Right. As you rightly said, that the BNPL model is not new in India. Even in my old days, the grocery shop example which you have given, it's a proper BNPL. Every month first, some money has to go to the grocery shopkeeper, and that cycle keeps on happening. The first BNPL model in my working career I have seen from a big lender now. It's a Bajaj Finance consumer durable loan. That's a BNPL what we have seen, right? The entire consumer durable industry growth is because of the EMI loan and all. That's a BNPL model. So the sustainable, what happened to the BNPL model where there was an accident? They were not very focused about the use of the loan. What they were funding is very low ticket size, right? The BNPL sustainable model, in my view, would be a kind of a consumer durable, a medical expenses loan, a kind of tuition fees loan. That is a kind of BNPL model can flourish in India rather than a very low ticket size, because the low ticket size doesn't provide you a credit worthiness. It doesn't kind of very profitable in terms of the low ticket size model and make it as a profitable, because the credit worthiness determination would be very difficult. Your unit matrix will not solve.
Yes.
Right. So in my view, the sustainable BNPL model has to be a some mid ticket size and kind of 9 months, 8 months, 9 months kind of loan, 9 to 12 months kind of loan. That can be a sustainable model.
I agree. Balaji, you would like to have some thoughts here?
Yeah. So yeah, BNPL, the history of it aside. So today we are talking mostly about BNPL from the consumer point of view. I would like to imagine it or reimagine it from the SME point of view. If you look at pretty much all SMEs, even for that matter, middle to large businesses, working capital is always a challenge. And how do you handle your inventory? That is a space where BNPL can be of real good value, because how quickly can my inventory move out, right? And how quickly I can make money, and when I should make my payment to my suppliers in order to stock or restock my inventory. In that space, BNPL has a very good use case. If that can be exploited, that can become a real significant play as far as BNPL is concerned, right? That's my 2 cents on it. Having said that, we all know the challenges of SME lending or SME financing, where personalization is, customization or personalization is the essential at scale. But having said that, if you could crack that, that's a very good space where this could evolve successfully.
Right. And my experience also, for BNPL was around Amazon Pay Later and Flipkart Pay Later, which came into our e-commerce, purchases without even a glitch. So it worked fantastically. And it was not something which I needed, but it really helped me make the purchase immediately without having to worry about the, but they were actually short ticket services, short ticket credit itself. So that's where, that was the first experience. And then I believe that has evolved into, the audience here is beautifully young at heart, but that has evolved into the Gen Z more for convenience and for, availing those products and services that, any thoughts on that, around that as well?
Sure. So see, what you have mentioned here, okay. So why the accident has happened on the BNPL? Any guy, when a finance company lends, there is an ability to pay, there is a willingness to pay, apart from the fraud, right? The, kind of e-commerce website where you were gathering the BNPL loan, they know your data.
Correct.
They know that what kind of buying you are doing, you are paying through which credit card, they have your credit card scores, right? The accident has happened when you are funding to those guys at a low ticket size, right, where you don't know the customer well, right? So that is the reason the scalability of the model doesn't depend on the small ticket size. When you want to scale the model, like the e-commerce grocery item or e-commerce Gen Z model, what you can scale up.
Correct.
You cannot scale up that model in a big way. You need a slightly bigger ticket size.
Correct.
Right. And then if you can scale up that business model with a low credit cost, with a sustainable ROE, I have not seen that model yet.
Right. I mean, I'm also waiting to see that if BNPL can evolve into a long-term credit instrument rather than a short-term consumption tool, especially in a price-sensitive market like India. But I believe that will really require a lot of credit bureau reporting to happen. Also product innovations, like credit limits for EMIs for essentials like education or healthcare, as you rightly mentioned. So that could be one of the steps in the right direction. That's on the BNPL side. Soumee, I'll just come to you on the alternative credit score. We spoke about lending, we spoke about BNPL. But I'm still worried about those 90 crore Indians, which need to be banked but are currently unbanked. Is there a way, how viable are surrogate data points like, for example, mobile usage, utility bill payments, psychometric data, for underwriting in semi-urban and rural markets?
Yeah, I think these alternate data points are very crucial for reaching out the unbanked and the underbanked segments of our country. So I think data like social media, phone data, even utility bills, these kind of data can work well in reaching out to those people who do not have otherwise access to credit.
And we're talking about consent-based data. We're not talking about anything, without any consent.
Yeah. So, however, the challenge lies because these data points are not available with the credit information agencies.
Yeah.
And at the present, there's not much available. Lenders cannot have access to the data. And it's also difficult to verify that sort of data. While you may still verify rent payments, utility bills, but social media data, these are all subjective. And it's very difficult to interpret them by the lenders. So I think a way forward could be when there is data sharing between the players as well as with the CICs.
Correct.
So for instance, like, RBI had come up with the account aggregator framework where they, it was envisaged that there will be sharing of financial information. Obviously, these kind of models take time, and it also depends on participation from all the players. So yeah, subject to all these things, I think if there is common sharing of data between the players as well as the CICs, that could help a lot.
Absolutely. Glad that you brought up account aggregator. One of the brilliant examples that we had at Bank Bazaar is that, customers were complaining us that we are really getting low credit limits. We are worth more, but their income documents don't support it. So, the models that we are using don't support it. So we just exposed those customers via account aggregator to exactly calculate their eligibility and enhance their income limits. Plus, obviously, acquisitions were also done via account aggregator. So it's a fantastic example on alternate data. I believe there's a lot more potential in that. We have seen mobile recharges also as one of the alternate data points where customers who are regularly paying mobile recharges have a different behavior towards paying EMIs on loans rather than those who don't. So there's a lot of content there, but it's as Soumee rightly mentioned, it has to be married with the bureaus and internal algorithms which are scorecards and all, and then probably functioned upon. Yes, Balaji.
Okay, so I have So what I'm thinking is when it comes to alternate data, I believe an infrastructure probably from the regulators is due.
Yeah.
Right? Who is best placed to hold common data, what I would otherwise call as anonymized data? It is with the regulators, right? As a part of the digital infrastructure, if there could be democratization of anonymized data made available from, the regulators, could be RBI, whoever that is, that could be a source point for identifying alternate means to underwrite credit. The information need not be, as I said, it's anonymized, but information need not be just about the financial profile of the individual or the business, but information specific to the region, specific to the, if you like, the segment in which people operate, etc., made available and democratized and made available to every player, big and small. From there, credit underwriting and lending can start. See, the problem is that too many people are chasing too few customers, right? And there's a lot of lending that could be done outside of the urban centers.
Right.
But the problem there is fragmentation of specific information. An agricultural entity in one city or one town could be very different from somewhere else in the country. But that information can be made available by the regulators. Government has these data, right? They can make it available. Marry that with the anonymized financial data and profile of individuals. We have it's a gold mine. It's a treasure. That can be made available. That can be kept up to date, and every business, big and small, could be allowed to dig into it and use that to identify alternate means of underwriting. From there, the innovation would evolve. So that's my take on. There's an element of what you call extraction of data, anonymizing it, making it relevant, and having it in a secure place, giving specific access to such data for individuals to further work on it, specific to their strengths or weaknesses, if you like. That would go a long way in expanding the lending market beyond what's being currently focused upon.
Yeah. Yes,
I
Soumee.
just want to add something from the legal perspective. It may not be feasible for the regulator to kind of frame regulations for each and every product, like
Right.
BNPL is a product, and come up with another regulation. That may not be possible. But I think the way we read and interpret the regulations will go a long way, because BNPL is nothing but digital lending, and as defined under the digital lending guidelines. And one of the provisions of the digital lending guidelines already mention that banks, REs, have to ensure that the credit scoring and these data have to go back to the CICs.
Correct.
So essentially the regulations are there. It's just the way we'll have to read them and interpret
Implemented,
them.
Yeah. Agreed. Yes, Sandeep.
Yeah, so see, my sense is that if I look at the evolution of the NBFC in this country, right? Since ages, they are lending with the assessed income. They are not lending to the reported income, right? And assessed income is what currently what we are doing is a UPI transaction. All the details are happening in your bank account, right? Your utility bills, your payment, all these things are happening through the UPI. So your assessment of the income can be a much better. And then as a model which is getting into then the GST, then the e-way, and then a hell lot of informations are there where if some fintech, and many of the fintechs are doing that, they are getting that information, they are making the business score, credit score model and all.
Agreed.
Is that what is not happening is the proper sharing of that model.
Yeah.
If that model gets proper sharing, like RBI has also come up with the unified lending module,
ULI.
payment module kind of, right? And that the proper sharing can happen, then the problem of the MSME, SME lending can get solved or can see a, kind of a light in a tunnel kind of thing.
Agree. In fact, you brought a great point on SME side where, GST transactions are utilized as an alternate data. Along with that, companies like Bharat Pay, they've come up with, assessing the SMEs based on just POS data, the POS transactions data, where the QR code is scanned and all, and that also is included in an alternative data to provide credit to the SMEs. So that's the take on alternative scoring method. From the audience, do we have any questions? We'll open the floor because we've been talking since 10 minutes and we've not touched upon topics like AI. Before I even go there, we just want to open the floor for audience and see if you have any thoughts to be or shared. Right, we have a question there at the end. Can someone please help with the mic?
Yeah, good afternoon. This is Ashish Balakrishnan from Poonawalla FinCorp. Yeah, my question to the panel is that you have been talking about a significant amount of unbanked population. Yeah, most of this unbanked population might have, possibly may not even have a smartphone, just a normal phone to use with, like some of our housemates or even the auto rickshaw drivers and all.
Correct.
How will fintech help in identifying those customers to be made bankable?
Right. You want to take that, Sandeep?
So yeah, you are right. So what we are talking about is small lending, right? SME lending, MSME lending, right? You are right. There is a good penetration of a smartphone, but let's assume that there is not, and there is a future phone kind of, right? But one thing is sure that currently, if I can't remember the number of QR codes which is there in the kind of every shopkeeper house or every shopkeeper, and we are just scanning and we are getting that, okay, UPI payment has been done. So the fintech model or the digital lending model, if we are thinking that is based only on the smartphone, the data is much higher than the smartphone now. The UPI mechanism, the NPCI mechanism has created one more leg of the record of the transaction. Was this how much is the payment he is receiving, right? There are models of the assessed income also of that MSME. And we know in the South, this model is from ages and people are lending some lakh rupees or something, right? From the assessed income all. They doesn't have a smartphone, they have a smartphone, but they doesn't want to do a kind of fintech lending. NBFCs are lending there. So there are ways and means now in terms of the digital ecosystem to, track their payment, to track the receives, what they are receiving. And based on that, the assessed income model can be formed. And which is there, which we have seen the evolution of the NBFC in the last 20-25 years.
Agree, and glad that you brought this up. I want to share that there is a company which is a 150-year-old legacy. These guys were dominant in their industry, but they still had to partner, with a fintech, with a 15-year-old fintech, just to bring more people under the category of getting banked. And I'm talking about just Muthoot FinCorp, who's just recently partnered with Bank Bazaar on, gold loans. So that's a secured loan which will bring this kind of population under the banking, formal banking channels and necessitate that credit history that is required for a customer. Even secured credit cards that we do, we actually have those kind of products which will bring them into the formal banking system first and then channelize them and offer them services which are available. Yes, Balaji.
We all must be aware of the financial inclusion initiative that came into picture, like
Jam
started off
Trinity.
in 2006, if I remember, at a very, very nascent initiative, and then it grew very well. We know companies like Fino. So it is backed by a lot of technology, fintech, until the last mile, right? The concept of business correspondents came from there. So the business correspondent goes to every corner of the country, like wherever villages, wherever they make disbursements, money available to them. The intent was also to bring such people who may not even have smartphones in hand to be able to be identified their credit worth being identified purely on a manual mode at the last mile, and then bringing them into the banking space. So it's definitely tough, but it's possible. So when you say fintech, it doesn't have to be via the smartphone in hand. It could be in the form of a device in the hand of a business correspondent who works with a few people in that particular node, the final touch point, enabling credit to them, relying on that person's judgment on the creditworthiness of the individuals that he or she is dealing with, and enabling credit, and then growing that slow and steady. I think the self-help group model of a group of people getting funded together, and hence correspondingly the payment getting collected successfully. In fact, the model was like 99%. The NPA was less than 1%, 0.5, 0.3%, better than even
banks,
other forms of credit.
Yeah.
So enabling people to see the possibility that credit can do, and how important for them to repay the credit once they have taken it, and then making it available to them with such kind of last mile goes a long way. So it's definitely possible, but it's definitely not easy. See, the financial inclusion, it took almost 15 years, and there was a time when banks were very unhappy because it was like draining cash. It was a drain on their, it was directly affecting their profits, etc. But now it has kind of stabilized, and a lot of benefits are being derived. So it's possible. We should not see it as the last mile being the fintech. The entire process being fintech, and the last mile being semi-fintech is still fine, but it's possible.
Agree. And the repayment behavior that you talked about with these kind of people is superbly amazing, like better than what banks' portfolios are doing today. Thank you, team Poonawalla, for bringing up that question. So just quickly transitioning to the risks involved in lending. So when we talk about lending, we talk about risk management 2.0, which is now led by AI. So Soumee, this question for you. With fraud detection increasingly becoming AI-led, what kind of challenges are emerging in terms of false positives or systemic gaps? And as follow-up question, as the risk shifts from institutions to algorithms, how can NBFCs and fintechs balance speed with safety?
Yeah, so I think, Ankit, a very valid question. So now AI is here, we all know, and I think the last panel had a very in-depth discussion on that. So AI can be used not only in customer acquisition, customer profiling and all, but as you rightly said, now AI is being also used widely in fraud detection and also compliance, right? So, however, one needs to be mindful that the more your AI is sophisticated, the fraudsters are going to come up with even more sophisticated way to crack the systems. So there are, yes, issues like malicious content can get, fed into the data, AI data. So these kind of challenges can come up. Right. Secondly, as you said, false positives also can come up. Then not just that, there are also issues about transparency of the data, like what we call as a black box problem, when we don't know that, when a decision was taken, how it was really taken. We do know what was the data which led to the decision making, but what was the process in the decision making which cannot be traced. Right. So I think having an audit trail of these kind of processes, these are the intricate ways that AI can be trained, for a future-ready fraud detection model, compliance model and all. And not just fraud detection, I think there are issues around, of course, data privacy, there are issues around transparency, there are issues also, around accountability, which we just discussed. But yeah, I think a way to look at this could be a human collaborative approach along with AI, and where you initially you could use AI in collection of the data or interpretation, but credit decision making largely, if it can be, with a human touch, I think then there's a way to avert these kind of challenges.
I agree. In fact, banks have nowadays started providing smart limits to the customers. So instead of just giving an open limit to the customers, they are assessing limits in a phased manner, where if the customer is utilizing up to, say, for example, 20% of the limit fully in the first phase itself, they're not being able to use the rest of the limit. So the banks are assessing spending patterns, usage patterns. Even I saw some of the fintech companies, on their customer journey page where they are entering the information, they are also capturing nuances like typing speed of the customer. If the customer is able to fill the page entirely mechanically, it probably is driven or backed by some or the other algorithm. So your thoughts, Sandeep?
So yeah, you just touched one part, that the typing, the other part is the swiping also.
Swiping, yeah.
Right. So if your card is registered in the India, in Mumbai and somewhere in the Russia and all, you are taking a swiping, that can be just gathered through the AI. Apart from that, the identity verification, right? Some video call is happening. In that video call, the AI can work like, okay, your face recognition along with your Aadhaar ID or PAN ID, which you have submitted, or which are the DigiLocker, from DigiLocker you can lenders can fetch, right? So the models are there in terms of detection of the fraud, right? This is the third layer, ability to pay, willingness to pay, and the fraud. These are the three major things when we see an accident, right? The models are there to prevent the fraud, yes. As Soumee said, that if we use the AI to, catch the fraud, but the fraudsters use some other AI model or some advanced AI model. The only problem which I have as a, capital market representative here, there is always a rush to give the credit. There is a lot of model is developed, to disburse money. But there are very limited model in terms of the collection and detecting the fraud. Companies are not spending, fintechs are not spending, I'm not saying that. But the thought process is largely in terms of how I deliver the credit, rather than how I collect the last 2 EMI, which is my profit pool. So that model needs to get developed.
Absolutely.
Until and unless the fraudsters and fraud will be there.
Right. One of the experiences which I would like to share with the audience around the same is that, there was a customer in our journey itself who had completed the entire journey with, impeccable details and was a very high profile customer. But thanks to RBI, because of that, in the VKYC, video, the agent just requested that customer, sir, can you just please be a little behind because you're appearing all over the camera. And when he went a little back, he was just surrounded by, vegetables and all, and was sitting in a vegetable shop. And his designation in the application was a director of a company and all. So that agent just flagged the customer, it went for review, and obviously I'm sure it wouldn't have, given a full credit limit and all. But that's the kind of thing that, these guys are still able to pass through entire journeys and, avail the credit facilities. From that just one manual intervention, we were able to flag that customer. And that was a learning for us and the banks as well. Your thoughts, Balaji?
So AI or not, fraud has always been there. Fraud prevention and mitigation has always been there, and it's going to be there, right? Like the panel said, in every board meeting discussion, the first question is how much loan was disbursed, as against how much of the disbursed loans of the previous years were collected or not collected, right? I think they're equally important, and I think many of the, when you're a funded institution, it's easier to focus on how much you disbursed rather than how much collection is, So, and it becomes a back office process, and that's always a secondary. As much as we speak about it, there's always secondary. So the challenge is how do we work on that process? How do we automate that process with AI or without it? No, there's no question that it has to be with AI because it rolls out things much faster, and also it can be a lot more specific. That's what we see. Like how specifically can we identify a potential fraud and whatnot. But having said that, it's always a catch-up game. There is never can we say that, okay, all frauds have been addressed or prevented or whatever. It is always a catch-up game. So the more the attention, the more the success rate. And it need not be only, it should be viewed into the entire process. Like for example, you go for a collection, we should be able to identify intentional defaulters from unintentional defaulters. So how do we address them? So each segment, how do we address them is how it has to be done. So when it comes to repayment of the loans, we should be in a position to identify patterns of For example, when is the right time for an individual to repay in the month based on their history, and accordingly have the flexibility to present for payment on that particular day, or how much can be how much of the policy on how much can be reattempted for collection, and if so, how do we intimate the individual, in what all means do we intimate the individual so that the money is available for collection. So this is how you differentiate between intentional and unintentional default. Once you identify the pattern, then you can treat them differently. And more importantly, all this data can get added into your own repository, which again feeds back into your analysis pattern. And this is once again where I keep coming back to having a central repository of anonymized data where such information is available, probably under the ULI or the OCEN network. It's a digital infrastructure from where information can be drawn. Having said all of that, it's always a catch-up. AI helps you as well as the fraudsters. So that's
Agree.
about.
And yeah, so what I was saying is, this is the nerve that you've touched for all the companies where it's not just about disbursement, but also about collections, because that's where profitability lies. And while we are on the topic, and I understand first panel had really spoken well at length on that, I just want to touch one more point here. Are we at real-time underwriting at scale using AI methods? Are we still there? Can we really make it in the future? Your thoughts, Sandeep?
There are models that real-time data can be shared, right? The other problem which is happening on the fintech lending, at one point of time, a customer is applying from the 5 loans,
Yeah.
and one by one, at least 2-3 loans get disbursed, and other fintech lender doesn't know that he has taken a loan from the other fintech also.
I've done that.
So, but the real-time models are getting developed. Again, what I'm saying is that what sir has said is the questioning should be how much you have collected rather than how much you have disbursed. See, the lending is the most easiest business. Collection is the difficult business of this world. So there are models where the real-time data can be shared, or MFI has some kind of, MFIN has some kind of regulation and all, where the data can be shared and all. But still, it is a time. It's still not properly developed, and there is a kind of lag in terms of information sharing. All these things have to come into the place.
Absolutely. I mean, I'm really glad that we were able to touch upon these topics, because though given the shortage of time, we might not be able to delve deeper. We'll love to have conversations parallelly, but the breadth of topics was really interesting. Thanks to Krypton team. Thanks you to all the panelists for the sharp and practical insights from how digital lenders are redefining, the reach and agility, from how BNPL has transformed to, different AI's real-time underwriting process, etc. It's evident that we are scaling up rapidly, but responsibility given the regulations around. And the common thread across topics has between collaboration between tech and governance, between fintech and NBFC, between growth and responsible growth. So as we move forward, it's clear that the future of lending will not just be digital. It'll be inclusive. It'll be intelligent and impactful. Thank you. Thank you once again. Happy to take questions from the audience. Yes, we have a gentleman over there. Yes, please.
Innovation coming in fintech.
Right. So next innovation after BNPL, would you like to take up?
See, again, lending is changing its course. Means, first you were lending through a traditional mode, then there is a 2-minute loan on the same salaried class customer, and now there is a BNPL mode. Okay, you buy the first, then you pay in the 9-10 months kind of thing. The form of lending is changing, right? The use of money, the use case, the market is getting extended. If you ask me, is the BNPL is a new innovation? I will say no. In India, it is not a new innovation. It's an age old. In 2012, 2013, the consumer durable zero EMI was a BNPL model.
Yeah.
It's not a new innovation. Innovation in the lending model has to be done with the, kind of assessing the credit worthiness of the customer, increasing the market, rather than what kind of new product you can offer. A doctor loan has been offered by many of the NBFC. Banks were not doing it. NBFC has come, they have assessed the income and they have given the doctor loan. It's a product. Was it an innovation? No, doctor was taking a loan with some other NBFC with some higher interest rate and all. So rather than, thinking about, okay, what new product I will develop, one has to think how the new credit worthiness or the new collection model I can develop. That is what my submission is.
Agree. And just add to the point.
Just to add to that. So if you want a prediction, then definitely my take is that the next innovation is going to be AI driven. What model? I can't tell you right now.
Absolutely.
But definitely it's going to be AI driven. Yeah.
I've seen, embedded finance. Whenever I want to book a ticket, they're ready to give me a loan for traveling. Whenever I want to book something else, they want to give me a loan for, everything. Even if I don't want, and that's at least visible. I think that, maybe in my life somewhere I'll be able to see invisible finance also, when I might not get that I'm given a loan already.
So this is a kind of cannibalization from personal loan.
Yes.
So if somebody getting a travel loan, he is getting a travel loan. If he needs to travel, he would have got a personal loan.
Correct.
So the point is that you are just changing the way of lending. Rather than thinking of a product, one should think how, kind of new credit worthiness has to be established.
Interesting. Thanks for the question.
I'll add to that point is that if you ask me what could be the new product, it is all based on the demand and supply.
Agree.
Okay. If the demand is that we need to have a product like gold, so there's a gold loan, right? If the demand is to have some kind of buying some stocks, we have loan against securities. It's all based on the demand, and accordingly, the product gets developed, and then there's a regulation around that, and then the other things all follow around that only.
The entire ecosystem is built around that.
I think that.
Absolutely.
Just one small point. I would like to, leave the audience with the point, personalization at scale, right? I have borrowed this from the likes of Swiggy, Zomatos of the world, who are able to provide the specific service you need, but pretty much to universally, right? So they have evolved the entire business process around that. In the lending space as well, we have moved from the borrowers coming to the lenders to the point where the lenders going to the borrowers at the right place at the right time, meeting them at the right place at the right time through all this embedded finance, finance at the checkout period, etc., etc. Yes. The next evolution from that is what kind of loan do you need at what time, right? And how do you want to repay that loan? Do you want to pay it in equal installments, or you want to do it in such a way it matches your business segment, your lean period versus your the period where your business is flourishing. That kind of lending is what I see innovation happening, and that happening, of course, enabled by the artificial intelligence once again.
Yeah. No, glad that we had such a great and amazing session. Thank you to the esteemed panelists here, and thanks Krypton team for the same.
Thank you.
Thank you.
Thank you so much for your time. And I would request you all to please be on the stage while I invite Ms. Prachiti Thakur, who is the CEO and co-founder of Krypton, to please come and felicitate our moderator and our sessions. So, thank you so much, Mr. Ankit Bagadia, who's the Associate Director, Bank Bazaar, who moderated the session so wonderfully. Give it up for him, guys. Thank you. Next up, we have Mr. Sandeep Jain, Fund Manager, Baroda BNP Paribas Mutual Fund. So, let's give it up for him. Managing Partner, Bombay Juris Law Offices. So let's give it up for Soumee. Come on, guys. We need the last year here. Thank you. Then we have Balaji, Jagannathan, co-founder and chief strategist, 𝐃𝐲.io. Let's give them for Mr. Balaji, guys. Give him a huge round of applause. Now can I request you all to please take a picture? The picture. Now I would request only the panelists to be in the frame, please. Thank you so much. Thank you.